Hello and welcome to today's video. In today's video, we're going to be doing a follow-up on one of my previous videos, which was on bank stocks. So back in December, I had created a video where I had called out the various reasons why I felt that bank stocks are going to be under pressure over the next couple of months, and therefore one should stay away from bank stocks. And that video did not get much of a traction at the time. I don't see too many views on the videos, but if you look at the news, it's all been about bank stocks for the last almost 30-45 days because major banks have collapsed. And so that video, if somebody would have seen, they would have gained a lot of insight, and maybe they would have prevented losses on bank stocks that they were holding. So the idea here in this video is not mainly to uh, call out that my prediction was correct, but it is more to discuss in detail that if you at all want to trade bank stocks, then how can we do it today in today's environment? And so we look at a complete strategy that needs to be followed in order to trade the bank stocks today. So let's proceed. Before we proceed, a quick look at the disclaimer, which simply states that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please get in touch with a certified financial advisor and understand the risks in trading and investing. Another thing that I want to call out is that I have been posting my trades on the community tab of my YouTube channel. So you can go to my channel, navigate to the community tab, and there you will see the trades that I take. These are usually swing trades. So I open two legs for every trade. One, when I take the trade, that means I open the trade, and then when I close the trade, I post it. I post that as well. The usual duration of a trade is a couple of weeks. So I mostly am into swing trading, and I don't take very frequent trades or short-term trades. So even if you don't follow those trades immediately, you can always catch up with those trades because my trades last for like 20 days, 30 days, or even longer than that. Another thing is that these trades are being posted free of cost right now. I'm not charging anything, but in the recent past, I have seen that there is very little feedback. I'm not getting any feedback on the trades that I'm posting, whether it is being found useful by people or not. So if that continues to be the case, I'll stop posting these trades on the community tab. But if anybody is benefiting from these trades and you want me to continue posting these trades, please leave a comment on the video or on the community tab itself, so that in that case I will know that these trades are being found useful and I will continue posting them on the community tab. Also, if you want to be notified immediately, please subscribe to the channel and enable the notifications so that whenever I post a new trade, immediately you will get notified and then you can follow the trade as per your liking. So this is a screen from the last video that I had put. I'll leave a link to that in the description. I'm not going to talk too much about what I discussed in the previous video, but that video basically was calling out that bank stocks are going to be under pressure over the next couple of months. So I was suggesting that it is my decision to stay away from bank stocks for the next couple of months, and I gave a couple of reasons there. We'll quickly cover those reasons here and then switch to how do we trade bank stocks in current environment. So first thing was the compression of net interest margin. This I had discussed in detail in my previous video. So essentially, banks are in the business of taking money from depositors, paying them an interest rate. So banks essentially are in the business of taking money from depositors and paying them some interest. And then the same money which is held with the banks is loaned to creditors, people who are looking for loans, and then they charge a higher interest. And the difference between the interest that the bank pays out to the depositors and the interest it receives from the creditors, that difference is called net interest margin, which is primary source of income for the bank. And so what had happened was, as the Fed was raising the rates, the loans had become more and more expensive. So banks were charging more and more interest for the auto loans, for the home loans, and different kind of loans that they were giving out. But at the same time, banks had not started passing that benefit to the depositors. So one thing that I had predicted was that over the due course of time, and even bank CEOs have admitted this, that eventually if the rates stay high, they will have to pass some of that benefit to the people who are depositing money, because you cannot force the depositors to put money with your bank and not pay them anything, because the interest rates have historically been at zero, and then keep on charging higher and higher rates from the creditors to whom the banks are giving the loans. So eventually they will have to pay out these rates, and it starts with one bank. As soon as one bank starts giving out let's say 2% or 3% on their savings deposits or checking deposits, other banks will have to follow suit, because otherwise they will lose their customers. Everyone will flock to the bank that is giving those rates. So I predicted that the net interest margins will come down. And another reason for the net interest margins to come down is the fact that when your rates go up, loans become expensive. Less and less people want to take those loans. So understand the situation where depositors now are getting some interest on their money. Historically, it's been zero. But people who want to take the loans, a home loan or an auto loan or any other kind of loan, they don't want to take those loans. They want to defer their purchases because the loans have become more expensive, or they simply cannot afford it, so they don't take those purchases. So in that case, banks have a double problem because they have huge deposits coming in. They have to pay out these the interest to these depositors, but the source of income, which is the loans that they give out, have dried up. So banks cannot make any money, but they still have to pay out the interest to the depositors. So because of this, the NIM, or the net interest margin, it kind of collapses, which is the primary lifeline for any bank, because that is the core banking business. Take money from depositors at a lower rate of interest and give the same money or loan out the same money to creditors at a higher rate of interest and keep the difference. That's where the main profits of the banks come from. The second thing that we saw was that these banks, when they have the surplus money, as I explained, depositors can be more, right? So they have the surplus money, which maybe they are not loaning out to people. So banks cannot afford to keep this money in cash. They need to make some income on that money as well. So a safe way for banks to invest this money has been to invest in bonds, and these are usually the government T-bills, which are the treasury securities, or the mortgage-backed securities, and they get some interest paid on that. But the problem with these securities is that usually these are long-term securities. So mostly banks will invest in like 20 years or 30 years T-bills, and also in similar duration of mortgage-backed securities. So banks, when they invested in 2021 and even in the beginning of 2022, when interest rates were low, so let's say a bank went in and they bought T-bills and they were promised a rate of return of 2% per year. Now all of a sudden, with Fed increasing the rates, that those rates have gone up to 4.5%. It touched 5% also in between. So what happens is that the old bonds which were purchased in 2021, they lose their face value, because those bonds are now getting discounted at the increased interest rate. So on books, if you see, let's say a bank went in and bought $1 million worth of bonds in 2021, which is paying out 2% annual interest. Today, if you look at the face value of the bond, it may just be $600,000 or $700,000. So the bank is actually booking a loss on paper of about $200, $300, or $400,000, simply because the bonds which were issued in 2021 pay lower interest as compared to the bonds which are being issued today, and so their face value reduces. So with this is the exact problem which happened with SIVB. That's the reason why SIVB had to book those losses, because if you can hold these bonds to maturity, then there is no problem. You will get your principal back and you will every year make that low 2% return. But if you need money today, then you need to sell off these bonds in the open market, in the debt market. But these bonds will be purchased at a discount. So if you purchased bonds worth $1 million in 2021 and you're forced to sell it out today because you don't have cash today, you need it today, you're going to be forced to sell it out for $600,000 or $700,000. That means you lose a significant amount of money because of the higher rate of discounting. And that's exactly what happened with SIVB. That in this case, they did have the assets, but they needed the cash today. And those assets would have converted to cash maybe 20, 25 years, 30 years down the line, when those bonds would have matured, and they would have got back their entire principal. But the problem was they needed the money today. And today, when they went out and they sold the bonds in the open market, the value was discounted, and so they had to book losses of about $1.8 billion. And that created a big hole in the balance sheet. And this is not specific to SIVB. Other banks also have the same problem, because in 2021, 2020, and previous years, banks have invested into these long-term debt securities. That is a very usual way in which the banks invest into these securities. and they have to do it because any surplus cash that they have coming in from the depositors, they cannot afford to keep it as cash. They need to pay back the depositors, and so they need to make some money on this. And the safer instruments have been T-bills and MBS, mortgage-backed securities, which pay out this money. But because of the interest rates going high, now the securities which were purchased in 2020, 2021, the years when the rates were low, those securities still have a lot of time to mature. But today, if eventually any bank has to sell out those securities in the debt market, they are being sold at a much lower value than the face value. So that is where banks are holding to a lot of potential losses. And I feel personally that the Fed has increased the rates. They may stop increasing the rates much higher because they may want to pause and see whether the inflation is actually coming down or not. But there is definitely a very little chance of the rates coming down. So if the rates stay high, these paper losses at least are going to continue on the balance sheets of the various banks. And the third point I've mentioned here, we already discussed that at higher rates, the consumers will defer their consumption. They don't want to take loans. If you were planning to buy a car and your installment was X amount, and if that installment all of a sudden goes up by 20%, you would probably stick with your old car, right? You would not buy a car. You would wait for the rates to come down. Or even if you don't want to wait, you may not be in a position to afford it at all. So people have no other option but to defer their expenses, defer their credit consumption. And so banks have this dual problem. They have a lot of money coming in, being deposited, but they have no way to earn money from these deposits. And so this is the reason, all of these factors combined, I had predicted that banks are going to be under pressure. Banks are going to feel the heat now. And so in December itself, when there was no talk of banking stocks were doing really well at the time. I had called out that, in my opinion, I would suggest that people should stay away from banking stocks for some time, because banking stocks can be under pressure for the near future. So we have already seen four banks which have either collapsed, they filed for bankruptcies, or they were kind of bailed out by some other bigger banks and bought out. So we have SIVB, which was the Silicon Valley Bank, Signature Bank, the First Republic Bank, and Credit Suisse. So this is the primary thing I wanted to call out. This is a summary of what I had captured in my prior video. I'll leave a link to that in the description. So if you want, you can watch that video again in detail to understand what I had called out earlier in December last year. So now, given all this volatility and the background, how do we trade bank stocks? Do we stop trading bank stocks totally? The answer is yes and no. So today, one thing I want to call out very clearly is that as retail investors, we are dependent totally on the financial statements, the information which is made public by various companies, including banks. And these financial statements, especially for banks, are very, very complex to understand. So if you really want to understand what kind of an exposure a bank has, it's a very complicated process, because understand that as soon as the Russia war started, people did not know, even the expert analysts did not know how much exposure each bank has in Russia. If the operations were to stop suddenly, how much money would they lose? And so that was a question mark for everybody. Nobody has that answer ready made. It's not published on any financial statements as a number. So different risks can appear, and what all instruments the banks are holding on their books, which instruments are going to create a big problem for the bank down the line, we don't know that. And what would be the triggers for those problems, we don't know that. So as retail investors, we should understand one thing, that when there is a generic consensus that the banking stocks can be under pressure, it is best to stay away from individual banks. Because let's say there are 100 banks out there, small and big, it is not going to the fact that all 100 banks will fail. But some of these banks will fail. We've already seen 4 banks kind of fail till now. More banks can line up. If you are buying into individual stocks, then there is always a good chance that you can end up buying stocks in a bank that is eventually going to fail. So at this time, the best strategy is to stay away from individual stocks, no matter how attractive they look in terms of their valuations, in terms of their dividends. It doesn't matter at all, because the dividends and valuations will not matter if eventually you get to know that the bank is filing for bankruptcy. So at this time, capital preservation should be the priority. And in order to preserve capital, the best way is that the entire banking sector, the finance sector, has come down, and this is tracked by the finance ETF or the XLF ETF. So instead of trading banking stocks, I would suggest that the XLF should be traded at this time. That is at least what I would do. I would not trade any banking stocks. If you've seen my previous trades, you would have seen me trading Citibank earlier. I am no longer trading Citibank. The moment I decide to trade in the banking sector, I will be trading in XLF. I will not be trading on any of the individual stocks. And trust me, I mean no individual stocks, even including the biggest names, because right before Lehman Brothers crashed, right before even Credit Suisse crashed, these were the big banks. They are kind of considered as banks too big to fail, and even SIVB existed profitably for multiple decades before failing, right? So it doesn't really matter what the history of the bank is, how well they have been doing, and how uh, good the feedback from the analysts has been there. We have seen tons of times that companies which have excellent ratings given by the rating agencies, by analysts, they all of a sudden fail and nobody has a clue as to what happened. And then in hindsight, everybody understands what was the reason for the failures. But more or less, the learning right now is that markets are volatile. There is a fear of recession. There is a slowdown. The net interest margins, which is the primary source of income for the banks, is coming down. Some banks are diversified. They have wealth management, they have investment portfolios, they have trading portfolios. So they make money in multiple ways. They are not just dependent on the net interest margins. But we don't know how much exposure they have or how much of instruments that they are holding will eventually lose them money, right? What kind of hole has already been created on the balance sheets? So we cannot predict the future. So what I can conclude for sure is that over the next 6 months, maybe a year, some banks will fail. Some banks will feel a tremendous amount of pressure and they will fail. Some banks will not fail because they will get bailed out by bigger banks. Bigger banks or bigger companies may see that as an opportunity to buy out the small banks and add them to their portfolio. Some may be bailed out by the government. I don't know what's going to happen. But the easiest thing that we know is that any decline in the banking sector is going to be tracked in XLF. So XLF, the ETF, is going to become less expensive, and that's where you should invest, so that when the banks fail, they will simply drop out of the index and new banks will be added to the index, right? The index itself will decline, but then it will recover as well. The individual banks, if they file for bankruptcies, may never recover. So that is the difference in the approach that I would follow for myself. And if you like this, you can also follow this, but that is what my suggestion is. This is what I'm planning to do, that I will stay away from individual banking stocks, but I will not hesitate from trading the banking sector, because the banking sector is in a challenge right now, but every challenge is an opportunity. We usually want to find out things which are trading at a discount, right? The thing is that you need to know what is the right instrument to pick up. If you think that an individual bank, and I will not name any bank here, it could be the biggest banks, they're trading at a discount, do not, I would not at least touch those stocks, because I don't know behind the scenes what's going to happen with the biggest names. I know what happened with Lehman Brothers, and it was a big name. I know what happened with Credit Suisse, it was a big name. So for me, it is very, very clear that individual bank stocks can be risky, no matter the reputation, no matter what the CEOs are calling out in the earnings calls. If every CEO says everything is good, there's nothing to worry about, and then 2 days later, we see that those banks are actually filing for bankruptcy. So I don't want to rely on that. I want to have a basic understanding of how the markets operate. That if the finance sector is under pressure, it's been under pressure for the last 45, 60 days or so, and it's decline. That is where I would invest, so that I don't have any exposure to any individual stock. Now, some banks can fail, new banks can become the market leaders. I don't care, because as long as I'm invested in the index is going to replace the failing banks with the new ones. And eventually, when the markets recover, the index will definitely recover. An individual bank may or may not recover ever, but the index will eventually recover. So, this is the approach that I would follow. For some of you who are like ready to take more risk, you can stick with the big banks, the big four, and that also because the big banks, it's to a certain extent rightly said that they are too big to fail. Even if they reach to the point where they are about to fail, they get bailed out by one way or the other, right? So that is true for big banks. But again, this is an approach which I would not take. I would not bank upon the government or the bigger companies to come in and bail out anyone. For me, a more prudent approach at a time when the markets are volatile, when things are risky, would be to invest in an ETF which diversifies my risk. And basically, I don't have a risk because I'm not counting on any bank to do well. I'm counting on the fact that today the finance sector is not doing well, but in 2 3 years' time, the finance sector will recover and eventually it will grow. So that's my take. I hope you find it useful. I've repeated a lot of things many times, but that is just to put across the concept clearly. And if you like it, please share your comments and suggestion. If you differ with my thinking, please call that out as well. I would like to hear out your approach on what you feel, how we should be trading the banking stocks right now. Any other comments or suggestions are welcome. Please feel free to share this video with your family and friends. I wish more views had come on the earlier video in December. So anyone who's lost money on banking stocks may have got that extra insight, and maybe they would have taken their money out of the banking stocks before they actually lost it. That's it from me for now. If you have any other queries, leave them down in the comment section. I'll respond to you, and I'll catch you guys in the next video. Thank you for your time.